Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 286 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be useful for you in your long-term financial journey. Today, we are going to talk about the stock market and specifically the recent action in the stock market, specifically among tech stocks and some smaller stocks and just things that you need to know and things that you need to understand in order to kind of work your way through some of this turbulence. Today is going to be very descriptive. I'm going to tell you a lot about what is going on, and then tomorrow will be a lot more prescriptive. I'm going to give you some rules, some things that you can take with you in order to work your way through some of the turbulence that is occurring in the market as of right now. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. And that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. Now, if you have your ear to the ground with the stock market, or you own stocks, or you keep up with any of that kind of stuff on a regular basis, then you know that this past week was horrendous, right? Now, by the time you're listening to this today, I don't know what the stock market is doing on Monday, right? This comes out at 6 in the morning, so the market's not open yet, right? The exchanges aren't open, so who knows what the market is doing to this point today. But we do know that last week was an absolute bloodbath, okay? You just look at some individual names, right? I'll just kind of start today talking about some of these individual names that just got, destroyed. First off, if you've kept up with Peloton at all, and for those of you who don't know what Peloton is, right? Peloton makes like the at-home bikes, right? The workout equipment. It's not just bikes. They do treadmills and stuff like that too, right? But their stock just got absolutely destroyed last week. It fell below its IPO price and ended up closing at 27.06. And you may say, okay, well, what's the basis for this to be closing at 27.06? Well, if you just go back, let's say 3 months, right? If you go back 3 months, this stock was trading near 100, right? You go back 6 months, right? And this stock was trading 120, right? You go back a year, this stock is trading around 150. And like I said, it closed at 27.06 on Friday, right? So it absolutely plunged. And part of that was on the news that they said that they're halting the production of their bikes and their treadmills for the time being because the demand is just not keeping up with their supply. And then the market really didn't like that. Then Netflix, which I hope you know what Netflix is, right? We all know what Netflix is. It suffered its steepest drop in a decade, right? And again, I'll give you a little context for that as well, right? So Netflix was down 21.79% on Friday. 21% in a day is an outrageous move, right? And if you even just go back to the beginning of the week, or actually go a week ago. So you go the previous Friday. The previous Friday, Netflix opened around 5:15 to 5:20, right? And it closed this Friday at 397.50, right? That's down 23.2% in a week, right? So huge drops in some major companies that are tech related. And then several of the chip stocks, they continue to struggle, NVIDIA, AMD, companies like that, right? You add all that up, and the NASDAQ, which the NASDAQ is a market index, and it's the market index that specifically keeps up with tech companies, smaller companies. It had its worst week since the beginning of the pandemic, right? And you may say, oh, well, that's not that long. Well, that's almost 2 years now, right? If that has snuck up on you like it snuck up on me, right? 2 years. But it's the largest drop in a week that it has had in 2 years, which is not in any way insignificant, right? At Friday's close, the NASDAQ was down 7.6% for the week. This is its biggest decline since March of 2020, when global markets sank on COVID-19 concerns. It's also the fourth straight weekly drop for the tech-heavy index, the longest losing streak since a similar stretch last April and May. So, I mean, this has just been, like I said, it's been a bloodbath in the stock market. It's been absolutely horrendous for investors, and especially investors who have been investing in the types of companies that have become quite interesting and quite popular to investors over the past few years. Very tech heavy, not heavy earnings and cash flow type companies. Now, heading into this year, the story for tech stocks was outward rotation, right? Inflationary pressure was leading the Federal Reserve to signal interest rate hikes were coming, and shares of cloud computing companies and other high multiple stocks that outperformed the market in recent years were plunging as the work from home theme fell apart, right? And let me just explain real quick why this is the case, why inflation has such a profound impact on these particular types of companies. Because when your company, right, it relies on some type of outside funding, right, which a lot of tech companies do, and especially a lot of young tech companies, they rely on their ability to raise money. And some of that money has to be raised via debt because they are not profitable. They cannot just use their own retained earnings in order to, fund their operations. They have to, over long periods of time, either issue shares of stock or issue new bonds or take out new loans or whatever, right? And in doing so, as inflation increases, then interest rates are going to follow subsequently at some point, right? And interest rates, especially the rates on particular bonds and particular loans, have been increasing, even though the Fed hasn't moved the federal funds rate yet. Right. And so as that occurs, or as that is perceived to occur in the future, which is a lot of what we're seeing as well, that has a profound impact on these types of companies because it becomes more costly for them to borrow, right? And, lending gets much tighter. And when lending gets tighter, then the amount of money that gets lent out to these types of companies will be less and less, and that will give them less ability to grow in the future in the same way. And then obviously more costly to borrow makes the value of the firm go down, right? Whereas if you have a company that has great cash flows, that is a great company, has predictable earnings, has the ability to live on the cash that it has, right? Especially some of the large companies that have a lot of pricing power, then you don't have as much worry about inflation as these types of companies do. And we're seeing it as these particular companies, these smaller tech, not so profitable, not so cash flow heavy companies are getting absolutely slammed by the market. Now, business fundamentals still appeared to be solid though, and the economy was on the upswing at the end of the year going into this year. Now, that confidence waned this past week as terrible news in pockets of the technology sector raised concerns with the wave of Q4 tech earnings reports set to kick off in the coming days. Peloton on Thursday reported preliminary results and said that the number of connected fitness subscribers will fall short of expectations. And if you know anything about the stock market, you know that the stock market thrives on what? It thrives on expectations. Because the value of anything today, and this is something that if you are a finance major in college or you know anything about finance, you should have a general understanding of this. The value of anything today is equal to the present value of all future cash flows, right? You're only willing to pay for a stock today based on what you expect it to do in the future. So expectations are extremely important. So if subscribers are going to fall well short of expectations, then the amount of money they bring in is going to fall well short of expectations as well, which has an impact on the value of the company. Okay. Now, Peloton, they also put out a release after CNBC reported that it's temporarily halting production of its connected bikes and treadmills and looking for ways to control costs, right? Which, again, none of those types of things are good signs. The CEO of the company said that as we discussed last quarter, we're taking significant corrective actions to improve our profitability outlook and optimize our costs across the company. Right, their shares plummeted 24% on Thursday before a partial rebound on Friday left them down 14% for the week. The stock closed at 27.06, but its IPO price, I said it dropped below its IPO price. It came public in 2019 at the price of $29 per share. And like I said, they closed at 27.06. Now, something that's particularly interesting about Peloton is that a lot of their leadership sold a lot of shares really close to the high watermark for the company. So, I don't know if we can, chalk that up to anything significant, but it gave us a very good view of what was going to happen in the coming months. Now, Peloton is a niche company with a product that saw high demand during the early days of the pandemic when consumers were stuck at home and gyms were closed, right? So if you just go back and you just look at Peloton stock, during the pandemic, right? We can go back to, let's say, let's just go March, the first week of March. We'll go from March 6th of 2020, right? And if you go from March 6th, 2020 to December 24th of 2020, the stock was up 551.4%. So for the year 2020, outstanding, right? But now we're at a point where from that date of March 6, 2020, the stock is only up 8.33% from then to now, almost 2 years later, right? So quite the story of ebbs and flows for that particular stock, right? But what might have been dismissed as a one-off gained significance after hours on Thursday when a much bigger company, Netflix, shocked the market. Right, the company said that it expects to add 2.5 million subscribers during the first quarter, which again is far below analyst estimates that were 6.93 million. Again, you miss expectations, then what happens? The stock does not do quite well, right? Because the price of the stock is based on expectations and growth. The stock fell 22% on Friday, the steepest drop in almost a decade, and slid 24% for the week. Investors followed by selling out of streaming audio service Spotify, which dropped 11% for the week. Gaming company Roblox, which declined 13%. Meanwhile, Amazon had its worst week since 2018, dropping 12%. Trading apps Robinhood and Coinbase had a rough week as well, falling 14% and 17% respectively, amid a market slide in speculative assets, right? Because both of those companies rely heavily on the individual trading a lot of speculative assets. And when individuals aren't trading speculative assets, then the expectation for future growth of those companies declines pretty severely. So let's just look at a couple of these companies that some of you may know and love and have heard of. So let's just look at Amazon, right? We all know what Amazon does, what Amazon is. Hopefully right? And we can just kind of get an idea. Again, we'll go from that March 6, 2020 date, right? And from March 6, 2020 to even, let's say, July 23rd of 21, Amazon, which was already a large company, had almost doubled. It was up 92.34%. But as of now, from March 6, 2020, it's only up 50.06%. So from that July 23rd date of 2021 to Friday's close, the stock is down 21.98%, right? So pretty substantial drop in a company like Amazon, which I would argue is still a very high quality company, right? Which is part of what I'm getting at today, right? I know I'm being specific with some companies, but what I want you to understand is that a lot of these companies, I'm not saying all of them, right? Peloton has its own problems. Netflix has its own problems. But some companies get caught in the crossfire, right? Some very good companies, maybe like an Amazon, would get caught in the crossfire. You could think about companies like Microsoft, right? Microsoft, one of the most valuable companies in the world, and it is well off of its high. So just year to date, right? So for this month, it's down 11.57%, and you take it from pretty close to its high of 42.45 down to the close on Friday, it's down 13.56%, right? So a very high quality company as far as cash flows, as far as being able to grow in the future. still down substantially. Apple for the month down 10.77%, right? And again, if you back that up just a little further and you say, okay, well, from its high, its high was actually at the beginning of the month, so it's still down a little over 10%. So my point here is that you have some very, very good companies that have been caught in the crossfire of this tech selling, because a lot of people, they sell either, a market index, or they sell some type of ETF that may hold some of these companies, or people just do broad selling, right? And the institutions just do broad selling based on market sentiment and momentum and things like that. And these types of companies still get caught in the crossfire, right? And I also wanted to discuss just the movement of the ARK ETFs, right? So specifically the ARK Innovation ETF, which is run by Kathy Wood, and she had some outstanding returns mid-pandemic, right? Especially there at the beginning. Again, we go from that March 6th of 2020. We go from that date, and if you go from there to February 21st of last year, so in less than a year, right? Almost a year, the ARK, ARKK ETF, that's the ticker symbol, had gone up 200.48%. But from that March 6th date to now, the ETF is only up 37.25%, having closed at 71.52 on Friday, right? So from that peak in February of 2021, the ARK ETF is down 54+%, right? So pretty substantial, even for a diversified group of companies. But a lot of these companies are in this crossfire. They are in this area. Peloton, I don't know if it still is one of the holdings, but it definitely was. Roblox for sure, Tesla, all these types of tech companies that are very, very popular, and they're getting hammered as well. So if you own that, you've gotten hit pretty hard. But let's just think, what if you've owned the S&P 500 and that's it, right? That's all you've owned. You've just owned the S&P 500 and you're just minding your own business. What are you down this month? Well, if you own the Vanguard 500 Index ETF, right? Just this month, you're down 8.32%, right? So not as bad as even Apple, not as bad as Microsoft, not as bad, not even close to as bad as Amazon, not near as bad as some of these big tech stocks, all these types of things, right? So just owning the index, the large diversified index, then you're still winning, even though, the value of the account's going down. You are still winning, even if you feel like you are not winning. And then we'll just go even further here. We'll look at the Dow for the month, right? If you were to have held the Dow for the month, then you're down 4.69%. And so the DIA would be the Dow's ETF. And like I said, that is only down, a little over that. The ETF actually is down 6.38%. Year to date, but that's less than the S&P. That's less than all these other things that we're talking about, right? So substantial losses nonetheless, right? And things that may make you, shaking your boots a little bit, but ultimately it could be worse. So being a diversified investor, understanding that holding indexes, continuing to buy indexes is a good thing, is something that we need to remember, right? And something that is, it might be very helpful to us, and it might actually hurt as well, is the fact that earnings season is here. Okay, it's something we need to keep in mind. Tech earnings season starts in a big way this week, with IBM reporting today, followed by Microsoft tomorrow and Intel on Wednesday. Of the three, Intel suffered the largest drop this past week, falling 6.6%. That was part of a broader decline in semiconductor companies, as AMD, Qualcomm, and NVIDIA each dropped more than 12%. Supply chain constraints remain a problem, and investors may be expecting some troubling forecasts on device sales as earnings trickle out. Researcher IDC said last month that the PC market will likely slow this year following 2 years of double-digit growth. In a report on Thursday, analysts at Piper Sandler, which is an investment bank, downgraded AMD to the equivalent of a hold from buy, based in part on the trajectory of the computer sales, right? So this year is shaping up to be something very, very different than what we have seen in recent years, right? The S&P hasn't beaten the NASDAQ in 2 consecutive years since 2006, when it finished a 3-year run ahead of the NASDAQ. While it's still very early to make the call on how this year will wind up, tech is off to an ominous start and investors enter earnings seasons definitely on the edge of their seats, right? And that might be where you are today. You might be on the edge of your seats. And all I can tell you is to stick to what you know and hold on. I'm going to have some rules for you tomorrow, right? Some things for you to actually take away and say, okay, I can apply these rules to a choppy market, to a treacherous market, and be a little better off, right? That's Josh Brown, who you guys may have seen on CNBC. He came out with this blog post talking about these rules, and I'm like, these rules are fantastic for bad markets, and it's something that I want to convey to you all. But what I have been doing, right? If you want to know how I navigate something like this that's been going on, of course, we are not selling, right? There is no selling that needs to occur, because selling means locking in losses, right? And if you don't know what I mean by that, what I mean is, especially in your brokerage account or whatever else, right? If you if you own something and it, is fluctuating in value, of course, the value of your portfolio is going up and down over time. But the moment that you sell it, it's final, right? Whatever loss that you have or gain that you have is locked in. And then that stock or that asset may continue to do whatever from there, but you don't own it. So you're not going to be able to feel the impact of whatever it does. But, a stock could drop or the market could drop 30%. But if you continue to hold the market index and it rebounds all the way back to where it was, then you didn't lose 30% of your money. You just lived through the volatility of the market dropping that much. So there is absolutely no selling to be heard of, right? Of course, there are individual names that are extremely interesting, right? So if you're an individual stock picker, if you're somebody who buys individual stocks and does your own analysis and makes sure that companies are worthwhile, then this is a good market to go in and say, let's find good companies and let's find them cheap, right? Obviously, I'm not going to give you specific recommendations on this show because that's not my job for you. It's your job to go do the work, or it's your and your financial advisor's job to talk about this. But there are definitely things out there that are cheap enough, especially with the market being like it is, in order to go and step in and buy, right? These are buying opportunities. It blows my mind that when the market falls or tech falls or whatever, right, we tend to freak out so much and decide to sell, right? That seems to be the natural slant of everyone. And I'm like, well, are we not buying and holding over the long term? Right, which most people are not, which is sad, but it's true, right? People are not buying and holding for the long term, which is the most profitable thing you can do, which is the most valuable thing you can do with your investments, right? So people aren't doing that, and they just defeat this whole purpose of the market being what the market is. Think about the market for any other asset, right? Let's just say oil, right? So this is a very close to home discussion because the price of gas has increased quite substantially as oil has increased in cost substantially, right? 2 years ago, approximately, when the price of oil dropped substantially and gas was really cheap, everybody was, thrilled, right? Obviously, it was the beginning of the pandemic, and that nobody was thrilled about that. But everybody was thrilled that, hey, gas is super cheap. And not even 2 years ago, year and a half ago, gas was really cheap, right? And everybody loved it, right? But as the price of that asset increased, then people got frustrated, right? So why do we get in a different way? Why do we get frustrated, right? When stocks go down, at least in the short term, right? I understand over the long term, if stocks go down, then we're not going to make money. We're not going to be able to grow our wealth in the way that we want to, right? But over a short period of time, right? If stocks fall, then they are giving you the ability to buy something at a cheaper price than what you would otherwise be able to buy it for. Right? Think about this. Think about if you were an art collector, right? Maybe it helps if I can make it something tangible, right? Think about if you're an art collector. And it's the same thing. It's an investment. Oil, gas is a little different because you're actually buying and using it up and then buying more over time, right? But let's say you're an art collector and you like this one piece, you really, really like it, but man, it's expensive, right? It's really expensive, and you're like, I don't really want to buy that piece if it's that price. But let's say for some reason somebody puts that particular piece on sale for a price that you are willing to pay, right? But you know the value of it hasn't changed substantially, right? If anything, the value of it's going to continue increasing over time. What would you do? You would buy the piece, right? You wouldn't be more frustrated that the piece decreased in value. You would be happy that it decreased in price and say, hey, the underlying value of that is still such that I would buy it, right? And why is the stock market any different? And it's a great question. Of course, there are companies that have real problems. Of course, there are sectors of the market that can have real problems at any given time. Of course, there are bubbles. Of course, there's a lot of overpricing that can occur. But at the same time, there's a lot of movements in the market that just don't make a lot of sense. They're not based on fundamentals, right? They're not based on any type of value, like real fundamental value. They're just based on supply and demand, right? And if you can find situations where the demand for a stock has waned, but the underlying value of that stock has not, it has not changed substantially, then those are going to be the buys. Those are going to be the things that are going to be really valuable to you. And that's for individual companies, obviously, right? But who's to say you can't buy indexes and you can't buy ETFs, right? And you can't buy, particular indexes that are going to be more diversified, even though they have fallen some. Yes, you might not get as much of a discount because it's more diversified, right? But you can still get some very substantial discounts in some ETFs. So I'll just give you an example. I'm not telling you to go buy this one. I'm just saying this is an ETF that I own that I've looked at recently because it's gone down quite a bit. So the Vanguard Small Cap Growth ETF Index, right? So this is small and growth companies which have been getting absolutely hammered by the market. So year to date, it's down 15.53%, right? And you're like, dang, 15.53%, that's a lot for less than a month, right? And it is a lot for less than a month. But, right, this is a diversified group of companies that over a long period of time have made a lot of money, right? If you just take the VBK, right? So you take this VBK ETF and let's just compare it to, let's say the S&P 500, right? Or let's do the total stock market index, right? The Vanguard total stock market index. And we compare it, let's say over a 5-year period. Up until November of this past year, it was beating the total stock market index by a cumulative like 17% over the past 5 years, right? Now it is trailing the total stock market index by like 12%, right? Because it's fallen so much since November, right? And this means, hey, I can get higher, and it's been well documented, you can get higher returns on small cap companies, right, over a long period of time in a diversified group. So, hey, I can get higher returns, but right now it's just in a slump. So that may be something that I'm interested in buying, maybe something that I'm interested in putting more money into. So just an example and just a way that you can look at things. Obviously, there's the S&P 500, there's the Dow Jones and NASDAQ 100, the triple Qs, all those things that you can look at to put money to work within. But ultimately, I just want to leave you with this today. Selling is not your friend in a market like this. If anything, holding on, finding areas of the market where you can invest effectively and put money to work and buy things at a discount is what you need to do. I'm going to come at you again tomorrow with some rules that you need to follow in treacherous markets, and I think I can give you some more things that can actually help you to move forward effectively in your investing life. But as of today, I want to put a full stop on your selling, full stop on your worrying, because this is what the market does. We may not be used to it in the recent past, and if you began investing in the past couple years, you're definitely not used to it. But this is what the market does from time to time, and I want to help you walk through it, and I want to help you to feel at ease with your investments as you move forward, even if the value has dropped, even if you feel like you've quote unquote lost money. I want to help put you at ease. And that's what I'll continue to do throughout this market drop. So thanks for watching this video. If you could, go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions. And you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual who's watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking to you about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.